Gold prices just broke out of a 3.5-year consolidation pattern. It's at a new all-time high and it's up close to 6% for the year, and people are getting interested. So is gold something that you should buy for the short term or for the long term? Let's find out everything about gold. So the first thing to understand about gold is that it's a non-productive asset, that the asset itself doesn't produce anything. It doesn't multiply to more gold, but it's got industrial uses. It's used for jewelry. But generally people buy gold because of psychological reasons. You buy gold because you think you can sell it to someone else who's willing to pay a higher price. And that person then hopes that someone's willing to pay an even higher price. That's a non-productive asset. Kind of like Bitcoin is non-productive asset as well. Whereas, for example, stocks and real estate and farmland, those are productive assets, because if you own real estate, that generates rental income. You own stocks of businesses, that generates profits through goods and services. You own farmland, that generates crops. So the asset itself produces cash flow. That's a productive asset. Whereas, again, Bitcoin and gold and silver, they are non-productive assets. Now, generally, in the long run, productive assets that produce things, cash flow, tend to outperform non-productive assets in the long run. However, in the short term, under the right conditions, non-productive assets can give you very high returns in the short term, in the right conditions. Now, so for gold, what are the conditions that drive the price up? So there are a couple of things to understand about gold. First, gold is affected very much by interest rates and the US dollar. So generally what happens is that when interest rates are increased, when they increase interest rates, the dollar will strengthen and gold will come down. So it's an inverse relationship. Now, same thing. Whenever they cut interest rates, the US dollar will weaken and gold will go up. So on this chart, you can see that relationship. So over here, you have got gold prices, and then you've got the Fed funds rate, which is the short-term interest rate, which is set by the Federal Reserve. And the third thing you see is the dollar index. So for example, over here, you can see that from 2016 to 2019, the Fed increased interest rates, right? So they raised interest rates. And generally what happens to the US dollar, the dollar will generally strengthen over here, and gold will then flatten, or it'll kind of like go down. All right. And then what happened in 2020? We had the pandemic crisis. So the Fed cut interest rates to stimulate the economy. So they cut interest rates. What happens when you cut interest rates? The dollar weakens. So the dollar weakens, and opposite, gold goes up. You see that inverse relationship. And then what happened in 2022? The Fed raised rates aggressively, so the US dollar strengthened and gold came down. Now, what has happened right now is you can see the Fed interest rates are at a high right now, about 5.25%, right? And right now, the market is anticipating the Fed will start cutting rates by this year. So they have not cut rates yet, but the market's like kind of thinking, okay, they will start cutting rates. And so because of that, the US dollar has really started to weaken in anticipation of lower rates. So the US dollar has weakened slightly, and that's why gold has started to rally. So the question is, in the short term, can gold rally even more from here? Well, it depends on your view of interest rates. So if you really think that interest rates will come down a lot this year and the next couple of years, and the dollar will continue to weaken, then yes, gold could go higher in the short term. The second thing that makes people buy gold is when there's a fear of a crisis. So like I said, gold prices are very psychological. When people think that, oh my God, we're gonna die, there's a financial crisis, the world's gonna collapse, they buy gold as a safe haven and gold prices go up. So for example, during the dot-com bubble, when the dot-com bubble burst in 2000, 2001, people thought, oh my God, the whole financial system's going to collapse, we're going to die. They buy gold and gold goes up. Same thing that happened in 2008, 2009, the great financial crisis, when the banks were collapsing. You can see over here, by the way, this orange chart is the S&P 500. So you can see when We had the financial crisis. People thought that the whole financial system was going to collapse. They bought gold and gold went up as well. All right. So again, gold goes up when there's a crisis. What was the most recent crisis? It was the pandemic. So pandemic over here, you can see global pandemic. We're going to die, right? And then gold, whoa, okay? So if you think that we're going to have another crisis, if you're one of those doomsday people, the world's going to come to an end, there's going to be a financial meltdown, go buy gold, right? Because gold's going to fly, right? Now, some people think that gold is a hedge against inflation. And that was proven wrong in 2022. Because what happened in 2022? We had super high inflation. And the Fed raised rates aggressively. And you can see this is the S&P 500 in 2022 went down. But did gold go up? No, gold went down. So gold is actually proven to not be a very good hedge against inflation. Because in high inflation, people thought gold would go up, but actually gold went down. Because the Fed jacked up rates, currency went up, the dollar strengthened, and gold went down. Now let's take a look at the technical chart patterns and see, is there an entry point for a trade? Now, for me personally, I won't invest in gold as a long-term investment, and I'll explain why more later on. But I will enter gold as a short to medium-term trade if I see a trading opportunity. So, first of all, if you take a look at the weekly candles, and this is over a 5-year period, you can see that gold was on a uptrend over there. This was back in, again, 2020 when we had the crisis, the pandemic. People bought gold, so very strong uptrend over there during that crisis period. And then once the crisis was over, people thought, okay, we're not going to die. And then gold went into this extended consolidation pattern. This is what we call a consolidation pattern, where gold kind of like went sideways for 3.5 years. And there's a strong level of resistance at the $191 mark. This is, I'm looking at the gold ETF, GLD. So what happened last week was we had a breakout. This is called a breakout of a consolidation pattern. So usually when you've got price breaking out of a consolidation, it creates bullish momentum that starts a new potential uptrend. So that could be a potential short to medium term trade. Now, if we zoom in to the breakout pattern, you can see over there, that's a breakout pattern. But would I jump in right here? You know, as a trader, I won't jump in right here because usually what happens is when you got a very big breakout candle, yes, of course, it could run, definitely, you know, but to me, it's a high risk trade because usually after a strong breakout like that, with a big candle, that usually is a bit of a pullback or retracement back near the previous resistance that will now become support before the trend continues, if the trend continues. So right here, first question you can ask yourself is this. Do you see interest rates coming down and do you see the US dollar weakening? If you do see that, then yes, gold could have momentum going up in the next couple of years. And or do you see another crisis unfolding that could also drive the price of gold up? So that's the fundamental or macro fundamentals of the trade. But the technicals of the trade would be, again, waiting for a bit of a pullback. So usually as a trader, I would say, okay, based on this breakout, I'll put roughly maybe about a 50% mark over here. And if the price can kind of like retrace at least 50% of this move, that could be a buy entry over there. But of course, we know that not all breakouts succeed. Sometimes it could be a breakout failure. And that's why if you buy over there, you then want to put a stop loss. I'll put a stop loss below this level of resistance and now support. Probably put a stop loss somewhere about here. And that would be my risk, right? Between the buy level and the stop loss level, that would be a 1-hour risk. And then we see if that trend continues. And you ride that trend. And then you could take profit at 2, 3, 4 hours, depending on how strong the trend runs. So again, I see this as, yeah, it could be a potential short to medium term trade, but I won't chase it after a strong breakout candle. I'll wait for a bit of a retracement, a pullback. And if there's an entry signal, yep, I could enter this as a trade. And I made probably enter it using options, using a bullish synthetic spread option strategy or other option strategies. That's more capital efficient than just buying the underlying ETF. Like I said, for non-productive assets like gold, I do enter it as a short-term or medium-term trade, but it's not something that I will hold for the long run as an investment. And the reason is because in the long run, like I said, non-productive assets tend to underperform productive assets. So here is a chart to show you the long-term returns of gold versus bonds versus stocks. And this is, let's see, from 1974 to 2022. So that's a very, very long term. So you can see that, over the long run, if you hold stocks, equities, right, the annual return is about 11%, right? 10 to 11 to 12% thereabouts. But you don't just look at returns. You like to look at what we call volatility or standard deviation. And the standard deviation of stocks is about 7.3% standard deviation. That's the kind of like the volatility up and down of that asset. Now, if you compare that to fixed income, which are bonds. Now, obviously, bonds give you lower returns in the long run. From 74 to the end of 2022, bonds delivered 7.2% return a year on average, with a 4.5% standard deviation. So one reason why people prefer bonds, although they get less returns, but it's okay, they think, because there's lower volatility. All right. But how about gold? You can see in the long run, if you hold gold through the ups and downs, your annual return is only 5.5%. So you can see, again, in the long term, gold gives the lowest returns with the highest volatility. So from that rational standpoint, that's why people like Warren Buffett, he doesn't buy gold, because he looks at the long term. He says, it's not worth it. I'm getting only 5% a year with all this huge volatility. I'd rather go into stocks where I've got higher returns with less volatility. Now, what does it look like on the charts? Let's take a look at this. So again, this is the very, very long-term chart of gold. And the thing about gold is that gold goes through very sharp rallies where it goes up a lot during crisis and when the Fed is cutting rates and the dollar is weakening. But at the same time, gold can go into very long periods of a bear market and long periods of consolidation when the Fed is raising rates and when there's no crisis. So again, you can see from this chart, it can stage very sharp rallies, right? Go up 700% in 2 years. But then it can go into a very long bear market for 20 years, going down 70%. Who's got the patience to wait 20 years as it goes down? You won't want to be in that period. Where stocks are the reverse. You find that for stocks, you have got long bull markets that last 5-10-year bull markets. But for stocks, generally bear markets last less than a year to at the most 2 years. All right, that's why I prefer stocks, because long bull markets, short bear markets. Whereas gold is short bull markets, but very long bear markets, And then, this bull market was pretty strong, right? So again, you got 649%, a very strong rally over here. This was during the dot-com crash and the great financial crisis. So two crises drove gold up. And then once the crisis was over, gold retraced 45%, then gold went up again during the pandemic, and then went sideways for 3.5 years. So you can see very, very volatile, long periods of consolidation, long periods of bear market. So not really suitable as a long-term investment, but great if you can enter and capture these very sharp uptrends in that asset. But you can see if you hold it for the long run through the ups and downs, you're getting only 5% a year. Versus, again, if you compare it with the S&P 500, the ETF, which is the SPY, if you compare it to gold. Now again, remember, gold is a non-productive asset, so it doesn't pay dividends. Whereas when you buy stocks and the S&P, you get dividends as well. So this SPY is with dividends reinvested. And you can see over the very long period of time, you get much higher returns, about 1,900% returns versus 500% returns for gold. Of course, if you know how to pick the most profitable high growth companies like your Microsoft, your Nvidia, your Amazon, your Mercado Libre, then of course that will way outperform the S&P 500 and way outperform gold. So for me personally as an investment, I prefer to focus on productive assets, high quality, high growth companies for the long run. But yeah, if there's a short-term trading opportunity for gold based on the technical chart patterns, I will enter it with a short-term trade using options, but predefined stop loss levels and profit targets. Hope this has been useful, and I'll see you guys in the next video. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.